Hey everybody, it's Aiden Pisarczyk and welcome to Sustainable Conversations. Thank you so much for tuning in. We have a great show for you today. Enjoy. All right, so we're back talking about bonds.
We're in the studio.
Finally, we got a new studio set up. We are really looking forward to start recording these and actually filming them so you guys can see what we look like in here. We got all the decorations and everything. It's pretty sick.
The podcast has gotten, to the point where...
That's right. That is right, Todd. I'm super excited about it. We're going to take this to the next level, hopefully.
Yeah.
Yeah, I'm really hoping to.
We've had a lot of people enjoying the work you've been doing, Aiden. I get a lot of compliments.
Definitely. That's great to hear. That's what makes me want to keep doing this and keep making it better. So I hope you guys like the new setup. We will be airing this on YouTube, as long as maybe on our Instagram and a lot of other places, hoping to really just bring you guys a little further into the world of our podcast by recording it and hopefully, making it more relatable.
Yeah.
So today we wanted to talk about bonds. I just wanted to get your perspective on them, and it seems as if bonds are probably a lot less understood, in generality speaking, than stocks. Yeah.
We get a lot of questions about bonds, and actually when we first started doing this podcast, one of the first comments I got from a client was actually asking us to do one on bonds, because it is interesting how many people, have a pretty decent understanding of at least kind of the concept of the stock market, but a lot of people don't understand much about bonds. And the reason that now is a great time is because with interest rates going up and all this talk about inflation, bonds are actually an investment vehicle that are greatly impacted by that. And so bonds are actually in the news now a little bit more than normal. And so it just, I think it's a great time to talk about bonds because it's something we've been wanting to get to anyway. And it's very timely with everything going on.
That's good to hear. So how would you explain a bond in the best way? Just in a general, in your own words, how would you explain a bond?
Yeah. So with a stock, you own a portion of the company. So when you buy a stock in a company, you're an owner. Yeah. When you buy a bond, and I know we're going to get into this more, but there's lots of different places you can buy bonds from, but you're making that entity a loan. So a bond is basically a loan to somebody, whether it's a company or the government or even like a municipality. You can make loans to cities and states, and it's for a set period of time at a set interest rate. So you're basically just loaning an entity money. Yeah. And it's, the terminology I think is kind of weird because we talk about buying bonds, and that term, it makes it sound like you're buying a stock, but in essence, when you're buying a bond, you're actually making a loan to an entity.
So it's not necessarily purchasing something.
Exactly. You're effectively, you are, in investment terms these days, we would say that you're purchasing a bond, but when you purchase that bond, it is a loan. Yeah.
That's super interesting.
Yeah.
So, and bonds can be used by, many different people. It could be like a company or a municipality I've seen, or creditors or.
Yeah. Yeah. So when you buy these, bonds they're issued by all sorts of different, entities. So corporate bonds. So there's a lot of bonds issued to corporations, Coca-Cola, Microsoft, etc. Governments, I think when we think of bonds, probably the most commonly thought of bond are like U.S. Treasuries.
Oh yeah.
Where you're, so great example when we look at and say, man, the U.S. has all this debt, right? Yeah. Well, how do they come up with that? Like, who's lending the government all this money?
Yeah.
It's people buying
mostly bonds.
Yeah. So it's, all of these U.S. treasuries and bonds, U.S. government bonds that are being issued. That's how the government is financing all that debt is, investors are making the U.S. government loans. Municipalities. So you can make loans. We're here in Vancouver, Washington. I remember when I used to work for a brokerage firm, our brokerage firm was involved in selling a bond to build the convention center here in Vancouver. So they financed that project by issuing bonds.
Interesting.
On the smaller scale, and these typically aren't things that you would find listed on the market, but I've even heard of church bonds where people will loan money to a church to like build a new church or whatever via a bond. Again, that's not something we're typically involved in, but bonds can be all the way from large scale projects all the way to small.
That thing you said about the U.S. And the debt that the U.S. is in, that struck me as pretty interesting. Would you say that like a big portion of the U.S.'s debt is owned within the U.S.?
That's a great question.
We don't have the example.
Yeah, we don't. But a large portion of it, yes. But also, I will say, side note, like when people talk about, we owe all this money to China, right? You hear that all the time. Well, really what they mean is that other countries, so there's a lot of investors or governments that actually buy U.S. bonds. So that's what they mean when they say that is, the Chinese government or other foreign investors are actually buying our bonds. So that's why when you hear, we owe China all this money, it's because they're purchasing our bonds. So, yeah.
That makes sense. That makes total sense. And then another thing that I was just wondering, you guys know this, as I do this, I don't necessarily know as much about things as Todd, so I come up with a lot of questions that I have. I think that when you're approaching buying stocks and bonds, I'm just wondering, what's the typical kind of ratio between that? Are you thinking that, obviously, again, you can't be too specific. It's different for every person. But in generalities, the difference between buying a lot of stocks and a lot of bonds, where would you think that lies?
Yeah. And I like that because, one of the things we generally point to in this podcast is we try to, spin it back to like, what does all this mean for me, right? Like I hear about bonds and what are bonds and everything else, but as an investor, what does this mean? Like, should I buy them? How much should I buy?
I'll stop you real quick before you answer this question. Actually, in my research, I found that the bond market is actually valued at 100 trillion, where the stock market is only valued at 70 trillion. This is as of May, according to SIFMA. But that was very surprising to me because I feel like stocks are much more talked about. Yeah. Whereas it looks like currently the bond market is actually valued at 30 trillion more than the stock market.
Yeah. Yeah. It's funny because we have, so to kind of back to your question about how much should you own in bonds. Yeah. So a lot of our clients have a good amount of their portfolio in bonds. I would say most of our clients have more money in stocks than bonds, but bonds make up, it could be, I would say like in general, a typical client who's retired might have somewhere between 30 to 50% of their portfolio in bonds. Sure. So even at that 30% level, that's obviously a very significant amount of money. As you said, the bond market is actually valued larger than the stock market. So it's this huge investment vehicle that typically, like when we do our reviews with clients, they're asking about how their stocks are doing because that's generally the more, I guess, exciting thing or the stock market's more in the news, and obviously you have a lot of volatility with the stock market and it's always going up and down.
Do bonds tend to change and have that kind of volatility as much as stocks?
So that's not normally. So the reason that bonds are in the news right now is because one of the things about bonds is they are greatly affected by interest rates.
Okay.
So I would like to get into this, and it's a great timing of that question. So normally, no. So the volatility in the bond market historically is not nearly as much as the stock market. However, this year, and with all the volatility that's been happening lately, we've actually seen a lot of volatility in bonds as well as stocks, much more than normal.
Okay.
The reason for that is because, so here's the way a bond works. If you buy a bond, And let's just use the example of I like that example of the Vancouver Convention Center. Okay. So I don't remember the exact rates, but at the time rates were much different. And so basically the city of Vancouver is trying to build this convention center. They need to borrow money to do it. So they issue bonds. Those bonds, and again, I'm just using a hypothetical example because again, I don't remember the exact terms of that deal. But an example would be they say, okay, we're going to issue a 15-year bond. Okay, so bonds are issued in all sorts of different maturities. You can buy bonds anywhere from, several months, weeks these days, all the way to 30.
So having a bond means that there will be a guaranteed or at least somewhat guaranteed date that you'll get your money back. And can you just pull out whenever or not the same?
Yeah. So you go buy that bond, and let's just say hypothetically you go buy that bond to help build the Vancouver Convention Center. And let's just say I'm going to use $100,000 because the math is easy. Okay. So let's say that it was issued at a 5% interest rate, and let's say it was for 15 years. Okay. What that means is if you put $100,000 in, and not all bonds work exactly the same, but the norm, the most common would be you get an interest payment every 6 months. So you put $100,000 in. If the interest rate is 5%, you're going to get $5,000 a year. But typically the way they break that down is that every 6 months you'll get $2,500. So you get a check for $2,500, or in modern era here, that money's just deposited into your account.
And that's not the part that you invested. That's only just basically the fee for them having your money.
Yeah, the interest payment. So you put $100,000 in, you get $2,500 every 6 months, and then at the end of the term, at the end of the 15 years, you would get your $100,000 of principal back. So is that guaranteed? That's one of the questions you ask. Well, as long as the project doesn't go broke, right? If the city of Vancouver goes bankrupt or something bad happens, bonds are not guaranteed. There is risk involved. But historically, the risk is a lot less than with stocks, especially, in the case of the U.S. government. The U.S. government treasury is considered to be the safest investment in the world because, although our government has, obviously we have issues with debt and everything else, but, we can print more money. So we just print more money and here you go, right?
Doing plenty of that.
So you have to look very closely at the issuer. It's no different than any other type of loan. Like if you're going to get a mortgage, so Aiden, someday you'll go buy a house and you'll have a credit rating. And if you have good credit and all the numbers are right, like you're buying a home for $500,000 and you're only trying to borrow $400, and the bank says, okay, great, Aiden has great credit, good collateral. It's the same thing with bonds. So there's collateral involved in these projects typically, to where if the borrower does go bankrupt, then typically the bondholders will get back, some of the assets that are sold. But if we go back to that case, so, as long as something bad doesn't happen, then the investor would get back that $100,000 at the end of 15 years. So what if you want out early? Okay, so that is another question you asked. So that's where the interest rates really come into play. Okay, so that's what we're seeing right now happening in the bond market. So if we go back to when I was able to get clients these City of Vancouver Convention Center bonds, back then interest rates were much higher. So that 5% I mentioned, 5% in this day and age isn't really available. Yeah. So what happened was over time, interest rates went down. So if you own a bond at 5%, so let's say I have this bond that I bought and it pays 5%. But the new bonds, let's say 5 years later, I want to sell it because I need that money to, do whatever I want to do with. Well, if interest rates have gone down to the point where, let's say the new bonds that are being issued at that time are only paying 4%, my bond is worth more because I have this bond paying 5 and the new bonds are paying 4, which means I get to charge what's called a premium. So the $100,000 bond that I have, I might be able to actually sell that to an investor for say $105,000, right? But the same thing happens on the reverse side. And that's what we're seeing happen right now in the bond market is people that bought bonds, let's say a year ago at rates that are extremely low. Like let's say that they bought a bond that was only paying 2%. Well, now that rates have gone up, it's really great for people that have cash and they're looking to buy new bonds. But for the people that bought a bond, like say a year ago or 2 years ago or whatever, and they were getting like whatever they're getting, let's say 1%, 2%, 3%, whatever they're getting, the rates market wide have gone up. So now if I bought a bond that was paying 2% and now rates are at, let's say 3 or 4 on the same type of bond, well, I can't, like nobody wants my 2% bond when they can go buy a 3 or 4% bond, right? And so for me to sell my bond, I have to sell it at what's called a discount in investment terminology, meaning if I bought a $100,000 bond paying 2% for, let's say, the next 10 years, well, now it's not very attractive for investors to buy unless I give it to them at a discount. And so that's what we're seeing happen in the bond market right now is people that bought bonds before rates started to go up, if they want to sell them, they can't sell them for as much as they paid for them. Okay. Now, we have to understand though, so if you're a bondholder, it doesn't necessarily mean that you should worry because we have to go back to the original example we gave. And this is really important with regards to what's going on in bonds right now. If I bought a bond, if I put $100,000 in a bond paying 2% a year ago, and again, let's say I did that let's say it was a 10-year bond. Well, if I own that bond and I just keep it till maturity, I'm going to get the interest payments that were promised to me. And at the end of the maturity, I'm going to get back the $100,000 I put in. So again, as long as the issuer doesn't go bankrupt or something, but the discounts that we're seeing or the value of our bonds going down right now is only temporary. That's only if we want to sell it early. If we hold it till maturity, again, as long as the issuer doesn't go bankrupt, you will get back what you put in. And so, do bond holders need to worry? Well, not necessarily, like not unless you're trying to sell it early, right? So,
yeah, moving on, I wanted to talk about the scandal in the 2000s.
Scandal
with the bond market.
Oh yeah, they made a movie about that, didn't they?
Of course.
Yeah.
Everybody's seen the Big Short. No, it's not the Big Short. What is
it?
it
Is the Big Short.
It is the Big Short.
Yeah.
Everybody's seen the Big Short. Read the book.
Not everybody.
I hope that most of you have seen it because it's a fantastic movie, fantastic book. Steve Carell is one of my favorite actors. He's great in that movie.
I think that movie kind of got you a little bit interested in this.
I think it definitely
financial
did.
industry.
I think it definitely. Yeah. There was a few movies that definitely got me a little bit interested in working in this industry. You have definitely The Big Short. You've got The Wolf of Wall Street. You got. I've not seen that. You have. I've only seen part of it, but then you've seen, and then what's the other movie I'm thinking about?
Boiler
Room. There's Boiler Room.
Which Boiler Room
That's
is a horrible, it's a great story, but it does not shine a great light on the financial industry.
It's a pretty good example of what was happening, I feel like. Anyways, so I know that whole scandal was based very heavily on false credit ratings. Right. So the credit ratings were very, very unregulated. So people are taking, AAAs, whatever, and rating. Very low ones and rating them as like AAAs and very good bonds when they're really just hollow, not, which created the whole bubble, which made everything crash. So I'm wondering what has changed now. You might not know too much about this. Obviously you're not the SEC, but what do you think that has changed now that might give people more trust? Because I could see a lot of distrust just with everything that happened. So what could you say to people to kind of like make it seem a bit more appealing? And you know,
so when we talked before about credit ratings, so in the bond world, you know, like if you go to get a loan on anything, like as a person, you have a credit score, you have the same thing with bonds. So a lot of the price of a bond and the confidence you should have as an investor in the bonds that you buy is based on the credit rating. So there are these agencies, these credit rating agencies that go out and they rate bonds. So let's say that I'm the city of Vancouver and I'm going to issue a bond. One of the first things I'm going to do is I'm actually going to go to a credit rating agency and I'm going to get a credit rating posted for my bond, because if I get a good rating, that's going to make it very attractive for investors to buy my bond. And if I get a low rating, I'm going to have to pay a higher interest rate, right? So just like you, if you go to get a loan and you have a bad credit rating, you can still get the loan most times, but you're going to pay a higher rate because you are a more of a risk to the lender.
So now it's a bit less of like, it doesn't make any sense to falsify that.
Right. But so in the bond world, the way the credit ratings work, so in the personal world, it's a score, right? It's 700 or 800, whatever. In the bond world, the credit ratings are, so AAA is the highest, and then it goes down from there. So it goes AAA, and then it goes down to AA, single A, and then it goes to triple B. Okay, so and so on. What was happening, and I don't know that I mean, yes, obviously movies like, you know, that Hollywood's making and everything else. Yeah. And, you know, the word scandal, I don't know if I would go so far as to call it a scandal, but
although,
people can decide for themselves, but it was certainly what was happening back then is I would probably say that the credit rating agencies, you know, nobody really knows for sure the motivation and was it scandalous or were they just lazy?
Sure.
But really the bottom line is that part of what contributed to the financial crisis back in 2008 and 2009 was that bonds that were being issued with a AAA credit rating, and these were specifically these mortgage-backed securities that were being issued with really high credit ratings. In hindsight, we've found that the rating agencies probably weren't doing a very good job of rating those bonds. You know, they were giving all these bonds AAA ratings when in reality, if you would have looked a little bit more in depth into the bond, you'd have found that, wow, there's some stuff going on in there that, okay. And so that people were buying these bonds with really, really, really high credit ratings and having confidence in them because of the rating, when in actuality, those ratings, again, was it a scandal?
Sure. I apologize. I gave the Hollywood kind of version.
You're just trying to pump up the ratings of the podcast. It's okay.
Exactly.
You know?
I'm a young kid. I'm trying to make this exciting.
Yeah. And, you know, but so you asked a very good question, though, Aiden, in all this is whatever happened, we don't know. Was it scandal? Was it laziness? We really don't know. However, what's been done?
Yeah,
because the issue is like with whatever happened, why ever it happened, investors today, should they have confidence in those credit ratings, knowing about what happened in 2008 and 2009? And I would say that, yeah, like I think that whenever we go through a crisis like that and we learn things, the credit rating agencies, I believe, certainly have learned that, okay, we missed that one, right? And they're not perfect. And we would say that, especially now, knowing what we've gone through, that investors, they should certainly look at the rating that a bond gets, but they should look more, right? Like, and so one of the things that we always preach is diversification. So with bonds, just like anything else, just because a bond has a AAA credit rating or whatever, it doesn't mean that you should put all your money in there. Diversification is always key. Not putting all your eggs in one basket is key. A lot of people, when they buy bonds, they choose to buy them via a mutual fund or an ETF. So if you buy a bond mutual fund, your money is spread out into hundreds or thousands of bonds oftentimes. And so if there is an issue with one of those, because even if a bond has a AAA credit rating, it's not guaranteed, right? Something could change, unforeseen. People that have the highest credit scores ever still have to default on their mortgages sometimes because their situation changes. So I think yes, have the credit rating agencies learned a lesson from what happened in 08 and 09? Yes. But I would also say that investors should have learned a lesson, which is no matter how good the credit rating looks, things can change, situations can change. The more we go through things like that, the more we come right back to these old tenets of be diversified. Don't like all the stuff we learn about.
All the stuff we talk about all the time.
It's why it's true.
Yeah, so makes sense. That makes sense. As we kind of wrap up this podcast, I just want to, I want to give you a space to say, what do you think is a good rule of thumb when approaching bonds in general? As the investor, as we try and, give a voice to the people who, are just listening and what do I do here? How does this apply to me?
Yeah.
So what do you think that a good rule of thumb is when it comes to bonds?
So, I will say I'll start off by saying what's not a good rule of thumb. Sure. Okay. Because
give me one thing to stay away from and one thing to do.
Okay. So what I hear as an advisor most common when I'm meeting with a client about bonds is, and I don't know where this came from, but I hear this all the time, is there's this theory that your age should be the percentage of bonds you own. So as you get older, you should own more bonds. I agree with that. And again, we'll just say, you should always consult with your advisor on stuff like this, whether that's us at Sustainable Wealth or whoever you're working with. These are the kind of decisions that really a professional, that's one of the main jobs we have, is trying to figure out what an appropriate allocation is for our clients. But the one thing that just me personally that I don't like is when I hear that, if I'm 70, that means I should have 70% of my money in bonds, right? Yeah. I think that's oversimplifying, and I would start off by saying I believe that's not the right way to do it. The percentage of your money that you have in stocks, bonds, real estate, and even the types. So, it would take 10 more podcasts to get into everything about bonds with regards to how you should you buy a 1-year bond or a 20-year bond or a 30-year bond? That, again, all those decisions should be left to your advisor, but it's all based on your goals. In general, bonds are less volatile than stocks. And in general, the types of people that like bonds are people that want an income stream. Because what bonds do well is they pay that, like we talked about, they pay a fixed amount of income that generally you can count on, again, as long as things don't go bad. They are less volatile than stocks. Oftentimes, they're a great diversifier and a great hedge against stocks. Not all the time, but oftentimes when the stock market is going down, the bond market will go up. Again, it's not all the time. And now is a great example. That's not happening right now. We've seen both stocks and bonds go down this year, but oftentimes bonds are a great diversifier and a great hedge against stocks. So, our thinking is that bonds, for us, most of our clients own bonds. Even clients of ours that are young, like yourself, Aiden, we would advise have at least a small piece of the portfolio in bonds. But the amount really should be determined by what your goals are, how much risk you want to take, how much income you need. And I really think that it's a tough question to answer, because I think there's so much that goes into that. And I think that is exactly why I believe all investors need a plan. You should have a plan to really help determine exactly what your allocation should look like.
Good to hear. That's perfect. Sounds like that's a great rule to live by. In very expanded terms.
Yeah, and I just think that overall, a lot of these, again, we hear all the time just, I read some article that says since I'm 60, I should have 6. Those things you have to understand. I mean, investing, I think now more than ever is becoming, it's very personal. It's very goals oriented. Yeah. Everybody's situation is different. And I just believe that you should take all that into account when determining what your allocation is.
Yeah. Perfect. Well, I think that about wraps it up. I think we've given a pretty good explanation. Hopefully you guys have learned a little bit from us, and hopefully if you have some questions about bonds that maybe we answered it, hopefully you have a pretty good overview of what they look like and how to approach investing with them. I know I learned a lot. I didn't know a whole bunch about bonds before this. But again, this is our first episode on YouTube, first episode on Instagram, and we are super excited to start sharing with you guys in this fashion. So check us out on Spotify and everywhere else that you usually listen to our podcasts. But now with the new invigorated studio, it's a little bit more interesting, and we're going to start releasing a flurry of episodes. We got quite a few that we want to do. Look out for next week. We're going to be on here with Taylor Vilhauer and Todd, and we're going to be talking about behavioral finance. That's a very interesting topic, in my opinion. Yeah. We've already actually done a run through of that. We recorded a podcast about it, but we decided, hey, it's probably not good enough for you guys. So we're going to re-record next week. It's going to be amazing. I'm super excited.
Awesome.
Taylor knows a lot about that stuff.
Yeah.
And so look for us on all kinds of platforms, and we just thank you guys so much for listening. We hope you have a great week. And anything else you want to say, Todd?
No, thanks again.
Thanks, everybody. Have a good week. All right, guys, we just have a few disclosures here. So please remember that the opinions expressed in this podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or in any specific security. The podcast is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referred for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Sustainable Wealth Management Incorporated is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Sustainable Wealth. The commentary in this podcast reflects the personal opinions, viewpoints, and analysis of Sustainable Wealth Management Incorporated employees providing such comments and should not be regarded as a description of advisory services provided by Sustainable Wealth Management or performance returns of any Sustainable Wealth Management investments client. Thank you very much. Have a great day.